Coming live from the New York Stock Exchange, we are into our second panel of the day. I am incredibly excited to sit down with Eric Balchunas of Bloomberg and Reggie Browne, who is a legend in the ETF space. Reggie, thank you for joining us virtually due to COVID restrictions.
Thanks for having me.
Excellent. We can hear you. We were so nervous we couldn't hear you. Okay, so we're going to talk a lot about the dynamics of how ETFs are changing and the role that they've played. Now, Eric and I talk regularly on Bloomberg chat, and poor Eric is used to writing an article and making a comment and me hitting him in chat like, how could you possibly say something so silly? But this industry, the ETF space, has seen remarkable change in the past year. Right? There has been incredible growth of active management ETFs. There's been incredible growth of derivatives ETFs. And it's effectively synonymous with the marginal flows at this point. And there's nobody better to comment on that than you, Eric, in terms of what we've seen in terms of the inflows that are coming into the industry.
Yeah, I mean, it's where all the fish are biting is the way I put it. So there was an interesting anecdote. There was a cannabis mutual fund that just converted to an ETF. And it had been outperforming all the cannabis ETFs, but nobody cared. And now it's converting to an ETF, and I don't blame them. They've got to go to where the dollars are. And so you're going to see more of this. To break the numbers down, if you look at this year, what, $650 billion, that's about $3-4 billion a day in ETFs. You look at some of these firms, we're $1 billion, we're $2 billion. ETFs do that by lunch. And at some point they'll probably top off, but they've gone way beyond my expectations this year. And to your point, what's interesting about the ETF flows is that yes, Vanguard and BlackRock dominate, but there is plenty of space for everybody else. And if you look at whether it's people who offer value ETFs or doing active, there are flows available for them. So basically, BlackRock and Vanguard are going to take about 60%, 63%. But then the rest, if you add that up, that's about $200 billion a year. So there is plenty over there too. But the other stat that's interesting this year is there's 2,400 ETFs. And I believe something like 1,700 or 1,800 have taken inflows. That is an incredible amount. So, like I said, there's a lot of desire to buy strategies in this wrapper outside of just plain vanilla beta.
Well, and that's a big change. I mean, Reggie, as I mentioned, you've been in the industry for a long time, but if I go back a year ago, really maybe 18 months ago, the pattern looked like it was heading in the same direction as mutual funds, where only a few ETFs were really taking in a ton of assets, and a lot of them were languishing. Do you have any thoughts on why we've seen this revitalization in the past 18 months to 2 years?
Well, I think there's a couple of reasons around that. Anytime you have a market movement where there's a market-wide event, the single factor beta ETFs tend to take the majority of the flows, both redemptions and creations. But when the market tends to flatten out and goes on its traditional cycle, you tend to see more thematics that take a lot of the assets and a broader range around asset allocation. So I think it's really around cyclical nature, depending on what the market is doing. And then if you look at the meme stocks and everything that happened over the last 18 months, you have a lot of retail investors that are following themes and then following trends, and they tend to pile into those ETFs, readily during that time period.
Eric, when you think about this dynamic of cyclical versus secular, how do you think about that dynamic? Because I completely agree with Reggie that there is a flavor component. Mm-hmm. It's also hard when you think about the dynamics of what are the flows coming in, because one of the things that I clearly saw, dating back to prior roles in hedge funds, et cetera, is an increasing acceptance of the use of the plain vanilla, to use Reggie's observation, get quick access through the queues, get quick access through the SPYs or VOO or something along those lines. How much do you think is increased acceptance by alternative asset classes, and how much do you think is actually coming in as new assets?
Yeah, it's a good question. I have this phrase called baseline. And there's about a baseline flow of about 2 billion a day into ETFs. These would be people just switching over to this format, right? Like people switching from CDs to streaming. Then if the market's raging or there's some part of it that's hot, like, I don't know, let's say a thematic ETFs, ARK had a big, last year was big for them. Then you're gonna see flows on top of that. We'll call that frosting. And I think that's what the cyclical flows are. Those will go though. I mean, some of those come and go. Yet I have this theory that if you have that shiny object moment and all the flows come and then you go down, you still keep half your assets. So you're better off than where you started. So not all of the money goes, but definitely it's more fickle when you go to the themes and the things that are sort of put on top of a portfolio, sort of as sort of your hot sauce or an attempt at alpha. But in a sell-off, I think what you're going to find is those things will take a lot less money, but you'll still have Vanguard and BlackRock plugging away with their vanilla. They won't crush it, but they'll see relatively pretty good flows to everybody else.
And when we think about the community that is adopting, I mean, certainly within Simplify, we see the importance of the ETF space to the RIAs, right? And one of the components there is when you're in the taxable accounts in particular, the tax efficiency associated with ETFs offers significant benefits versus mutual funds, right? The ability to not have to distribute capital gains. There's actually been some legislation that is pushing back on that. I'd be interested in your thoughts on where is this pressure coming from and is it likely to go through?
The call is coming from inside the house. Yeah. You guys remember that? They actually got the idea from a Bloomberg article. That's why I say that. There was an article written, and it was a good article, but the headline was very spicy. It was something like, Wall Street's dirty little secret is this ETF tax dodge. And so that's what, as Bogle was quoted saying, when you fearmonger on certain things, sometimes it'll be in the paper, and a congressman will read it and say, hey, there's something I can run on. And I think they read it and thought, this is a good idea, I'll go after Wall Street. I don't think they thought through that actually what you're doing is you're just annoying 12 million small investors by doing this. And the other thing is, I don't know if they really understood that the ETF, I think, is just a fair way to get taxed. You don't avoid the tax, you just are able to defer it. So all this would do is, it doesn't save 200 billion, it just gets the 200 billion a little sooner. I don't know, it's a really annoying thing they would do for the sake of something very small. So we had the professor from Fordham on who was in the Bloomberg article who Wyden's office referred, we try to get Wyden on the podcast, but they referred us to this guy from Fordham. And he was basically just saying, look, I mean, if a mutual fund trades stocks, it gets taxed, the ETF should be the same way. But I think most people would agree that the ETF's fair. You get taxed on what you do. You don't get taxed on what other people do. And I think that's common sense, logical, that'll probably win the day, and I think the odds of this going through are pretty low, thankfully, but it's not out of the question. It would definitely take away one of ETF's pretty big, main advantages, which is that tax efficiency.
Well, and I absolutely agree with your characterization of it and would highlight that this is actually one of the reasons why mutual funds dominate in 401ks, for example, right? Is because you are able to distribute the capital gains and then reinvest them without creating a taxable event. So there, to your point about the fairness, right? For the vast majority of people, we figured out some form of solution set to it. There are interesting questions around some strategies around this. For example, the Vanguard treatment and the heartbeat trades.
Yeah, I'd love to get Reggie's take on this too, but I will say that when that Bloomberg article came out, what preceded it was Elizabeth Kashner at FactSet writing about what she called the heartbeat trade, which is if you look at an ETF's flows, you'll see this boom, up and down, way beyond normalcy. And it looks like a heartbeat monitor. Perhaps they could have been a little slicker or less obvious about making this trade, which is purely a rebalance trade to wash out some gains. So I don't know, in retrospect, it was a little bold maybe to do that. Yeah. A purely tax washing trade kind of thing. That said, I still think if you're Vanguard or BlackRock or any issuer, and you have a fiduciary duty, one of those would be to limit taxes for your investors. So I would think you would be actually more guilty if you didn't do that. But I'm curious what Reggie thinks about whether they got a little too emboldened with the optics of that heartbeat.
Well, I would say this. First of all, the proposed tax changes to the redemptions or the creations of ETFs, it covers 50 million Americans with the average household of $125,000 in net worth. So it's far below the line of the rich, the 400,000 they are looking to tax higher. And these are just mom and pop retail accounts. And largely, when you talk about the heartbeat trades, if you think about what ETFs have allowed, look at fixed income corporate bonds. The efficiency now in the underlying corporate bonds, there's more transactions, the spreads are tighter, and the price discovery is more efficient because these ETFs are trading upon corporate bonds that are index eligible and the spreads are tighter. And so if you look at institutional investors, they are now foregoing trading underlying corporate bonds and trading ETFs because it's better for their end investor. So the heartbeat trade has allowed for trade efficiency and price discovery in a transparent nature, where you have a illiquid market like corporate bonds that you just don't know or understand the price unless you call 3 bond dealers. And there's a subset that trades on platforms. So I think that the $3.5 trillion that the Biden administration is looking to propose in infrastructure spending that has gotten Congress looking to how to raise revenue is being misdirected in trying to tax the little guy. And so for the heartbeat trades, this is a key efficiency metric that allows for the transfer of assets inside of an ETF on a regulated exchange in a regulated ETF through a regulated broker that has brought efficiency and transparencies. That why do you want to disrupt that? And I see why active managers would want to highlight this fact, because ETFs providing efficiency that mutual funds can't, because you're only being taxed on your trade, not the next guy's trade, like in mutual funds. So in my opinion, this will not pass. The heartbeat trade is an efficient method that brings liquidity and brings more investors to the marketplace that, in my opinion, will not be successful in repealing.
Well, we certainly hope that's the case, because we agree with that overall perspective. Another change that has happened in the last 2 years is the ETF rule and then the derivative rule. So 2019 for the ETF rule, 2020 for the derivative rule. I'd love to get both of your thoughts. Reggie, maybe you can start by talking a little bit about what has changed and why these two rules are important.
Well, I think, first of all, the ETF rule has flattened the playing field about the need of getting exemptions in order to bring a new TF out. So you're seeing more competition and lower prices in the ETF structure, and you're seeing more active managers come into the marketplace. So these are all great benefits, in my opinion. And then it flattens the regulatory cycle to allow for more competition. As far as derivatives, you're seeing a bunch of ETFs come out with option overlay and different strategies that allow for not only buffered income, but to allow clients to get exposure into strategies that bring in derivatives, more importantly, that enhance their revenues or offer protection. And so largely this brings in new structures that are somewhat in nature that needs more education. I won't use the word derivative, but in a nature that allows for more strategies coming in place that were in traditionally higher wrappers or higher fee structures, than now that they're available and accessible to everyone that understands them.
And just to add to that, I think both of those things just really kind of level the playing field, allowed more issuers to be on equal footing with other. There had been these sort of weird, like, okay, you can actually do custom baskets, but then they put a halt on it. Same thing with using leverage. ProShares and Direction couldn't do it. Now it's like, okay, look, we'll make it fair for everybody. I think the use of derivatives, I think it was Dave Nadig, I believe, used the word sculpt. And I think that's a good word. You can sculpt returns, and target your outcome a little better. And so we've seen a lot of ETFs utilize this, not only you guys, but Innovator with their buffer products. It's a shock hit. I mean, that just launched a whole new category. I think there's like 9 or 10 billion over there out of nothing. And that's going to try to disrupt the insurance industry. So I think the democratization that ETFs constantly are doing is just, you think it's over, and then there's a whole new category that comes out and sort of takes on this other area where maybe they're getting overcharged for underperformance or lack of value.
Yeah, I mean, that certainly is what motivated my transition away from hedge funds into the ETF space, was the opening up of the possibilities created with the derivative rule to sculpt the returns, whether that's to offer protection, to enhance income, in an environment in which there is an awful lot of resistance to attaching innovative strategies, and derivatives can kind of be a dirty word. It feels like the ETF space has taken a very thoughtful approach, recognizing the challenges of retail and education that Reggie was highlighting. It feels to me that the crop of products that are coming out are actually, they strike me as broadly very fiduciary and very responsible. Reggie, I'd be interested in your reaction to that.
Well, listen, there is $20 trillion in managed accounts or in an intermediary channel. And if you look at that entire sector of managed money and the products that are associated, they are traditionally in higher fee products. And when you allow an ETF to be rolled into these marketplaces, you not only introduce new concepts, but you also bring in competition at lower prices. So you look at the entire sector, particularly what Eric referenced, is in the assurance channel, additionally, higher fee laden opportunity in products that the clients are exposed to that only brings more transparency and greater access. So you look at derivative-based ETFs, and I'm hesitant to use the word derivative. If you look at ETFs that have option overlay or some sort of complex structure, that there is a fiduciary nature that it is paramount that the end customer understands how their products are designed and how they work and what market cycles are they meant to be used. I mean, we have some products in there that were around vol that very few people understood that once a volatility mark hit a certain metric, that the product expired. That's not good fiduciary or good governance, in my opinion. And a whole swath of retail customers don't understand that. So it's important that for the end advisor has an understanding about how best to use the ETFs that are being introduced, but also has a good relationship to the sponsoring firm to understand how best to deliver those products in client accounts.
And can I add on to that, which is, it's interesting, Innovator and your ETFs, they're kind of responding to different changes in the marketplace. For example, the buffer products are sort of acknowledging that bonds and stocks may go down together for a long time, right? So if the 60-40, if your bonds do not hedge your stocks, you're in trouble, right? So here's something that will use options to help you. In your case, you've seen that there's been these long 2-3 year periods of like the market just totally asleep, or as Einhorn called it, apathetic, I think, or nihilism. Yeah. But then boom, there's a catalyst and it just blows up. But then the rebound is tremendous. And so that's a new thing, right? So I think you see these products adapting to new scenarios as well. And in some of these cases, derivatives are a way to work around these new elements.
Yeah, I mean, certainly from my perspective, one of the primary motivations in spending the time educating people about the broader impact of passive that I've obviously talked about is not that you can't be invested, right? It's that you actually are forced to be invested, but you also simultaneously want to hedge, right? Now, when you think about, and Reggie graciously introduced some of the inverse volatility ETFs that had challenges a few years ago, shall we say.
Well, by the way, they're coming back.
They are coming back.
Yeah. We should have a new XIV and TVIX by Christmas time. So Santa may come early this year. And look, I will say, if you go to Twitter and you do hashtag XIV, there's some real, people miss that product. I hate to say it. I know it got a lot of flack, but people really fell in love with that product, and most of the sentiments like, oh, I miss it, I wish it were here. That's all I'll say on that. I'm not saying buy it or it's a good thing. I'm just saying people have an interesting affinity for that thing, and it went out in a blaze of glory.
Well, I certainly enjoyed it, but it was... I'd love to see it come back too. Yeah, exactly. There are alternatives, but this actually then again speaks to the dynamics of leverage. And where I was going to go with this actually is the question of crowding. And so when you have this type of flurry of innovation, one of the things that I always think about is, are we seeing evidence of crowding? And I'm not seeing it yet, but I'm interested if you're hearing otherwise.
This is where you and I always have this discussion. If you look at, when we look at fund flows, right? It was like, oh my God, all this money is going into ETFs and passive. And it's true. Over the last 10 years, $2 trillion has gone into quote unquote index mutual funds and ETFs, which, sorry, quote unquote, that would be passive, right? But $1 trillion has flown out of active equity mutual funds. So if you take that, it is a net zero. Now, I know passive is buying in a different mindset than active, right? They're more mindless. Still though, this is an interesting question. I ask people this all the time, and there's different theories, but if fund investors are not the ones net buying stocks, how is the market up so much?
Well,
and I know the buybacks is an answer, retail is an answer, institutions are an answer, and those are all probably part of the, but I would love to see a pie chart of exactly where the whatever 300% return has come from if equity fund flows are neutralized.
Effectively neutral, yeah. No, it's interesting, and so, again, this is part of where my work meshes with some of the academic work that is ultimately coming out, right? The intensity of purchase is different, right? So, and the assets that they're ultimately buying are different. And so there are segments of the market, if I look at many value stocks, for example, or I look at even more broadly the value indices, which tends to be the province of the active manager, they actually have trended sideways, right? They actually have, until the events of March 2020 and the subsequent rebound, primarily around the election of Joe Biden, which seemed to be a catalyst to some change. Broadly speaking, the Russell 2000 value had gone nowhere, right? Many of the value indices themselves had gone absolutely nowhere, right? And you can point to many sectors that had been favorites of active managers that had actually fallen over the past several years alongside a profit cycle, right? So you've seen that flip. And then there's the second component, which is just the broad dynamic. And Corey Hofstein at Newfound has done some phenomenal work on this, which is that the changing rules around index construction and the enabling of that by the regulatory authorities means that the concentration in the largest stocks, which is really what propels the broad indices higher, is anytime you fire an active manager who's running a diversified fund and you do something like buy the S&P 500 or you buy the Qs, you're automatically buying more Microsoft.
Right, you're tilting to those big caps a little bit. Yep, fair enough, that's fair.
And that has been a big driver of the market rally.
The crowding also, I think the Fed saving the market every time it goes down has somewhat eliminated fear of tail risk, and that has just helped this sort of crowding. I'm just going to keep buying and buying the dip always works. And so, it's this sort of upward spiral that keeps happening because no one has really, I think they feel more fearless than in the past.
Well, I definitely agree with. Right, and I think this is actually part of the point that you both have raised around the dynamics of can you rely on the traditional 60-40 portfolio, right? The Fed's ability to step in, lower interest rates, raise the price of the bonds that are held in a portfolio, and then have that in turn create a rebalancing effect. This is well articulated. Jonathan Parker at MIT wrote a paper about this in 2020 that seems to have been extraordinarily prescient in terms of identifying a mechanism how this rebalancing can affect it. But it's going to be very interesting if we get to a point. David Einhorn, in an earlier interview today, brought up that he's fairly skeptical that we're looking at transitory inflation, right? So if the Fed has its hands tied in its ability to respond by inflationary conditions, we could see a very substantive change. And I don't think any of us know the answer to that.
Yeah, no, in fact, there's a category that we call alternative in ETFs, which is essentially hedge fund strategies like long, short, managed futures. And the more hardcore and as much as they adhere to the way a real hedge fund would do it, the less flows they've seen over the past 10 years. It's largely an ignored category because no one needs to hedge when the 60-40 is doing so well. So we keep looking at that as the possible place where could be the new big deal in ETFs is the alternative space. And that's why when people say, oh, being an ETF analyst, it's not necessarily a passive thing. There's all these other areas that are ETFs are ready and waiting for this moment that you talk about to come. How about even the short ETFs, the inverse ETFs? They would see a lot of love. So, people say, oh, when the passive bubble blows up, everything, all the ETFs will go away. No, there's plenty of ETFs waiting for the passive bubble to blow up, whether it's small value, inverse, or alternative ETFs. It's just a wrapper.
Yeah. Reggie, I'm interested in your thoughts around this issue of active versus passive, not so much in terms of market impact, but in terms of how to think about what an active ETF actually is. Like, is it an active management strategy? When we look at many of the innovative products that are coming out, many people look at products like the 2x levered or the 3x levered type products that really got hammered.
Fun stuff.
Yeah, the fun.
We call them the exotics.
Yeah, the exotics, there we go. When we think about those, one of the things I would highlight is the mechanical construction of those products, at least historically, has contributed to the volatility drag that they've experienced, right? So if I buy a 2 times or a 3 times levered ETF and it continually rebalances, that is creating conditions for almost a perfect transmission of volatility drag, right? And volatility drag, just for the audience, if something goes up 10% and then down 10%, you've actually lost money, right? Because it's 1.1 times 0.9, you're at 0.99, you've lost 1%. The more volatile the strategy, the more leverage you apply to it, the more frequently you rebalance, the more you get that type of drag. And we're beginning to see levered ETFs under the label of capital efficiency that are less active in their, or less frequent in their rebalancing, right? Reducing that volatility drag dynamic. Reggie, I'd be interested in your thoughts on the evolution of those types of products, the exotics with maybe a little bit less sauce to them.
Well, I think you illustrate what the problem is and what the solution is. Transaction costs do matter. And when you have a levered product that particularly is based on a thinly traded sector, call it, I won't call out a specific product, but on a sector that is thinly traded, those moves are more exacerbated and you have a little more destruction in alpha based on some empirical analysis. And so anything that is rule-based, particularly passive products, over time, you have less transactional friction and leads to an outcome that reflects that. Versus if you have a lever product and the lever is a little less levered, and then the end client understands how they're constructed and how best to use them. And more importantly, when the leverage is applied and then the period where a creation or redemption is disallowed and it has more of a gamma effect, and then how to best apply that, all that is part of the soupy sauce that an investor needs to understand. So there is less levered, in the 3 times or the 2 times products where a regulatory, it was lessened or lowered to mitigate some of the effects you talk about. But active versus passive really comes down to rule-based versus fundamental decision-making by a PM. And so the rule-based ETFs traditionally are the themes or single factor. I don't think they're a big contributor to the market that we're seeing. This market is about confidence and then implicit fundamental action by our central bank called the Federal Reserve. And so all that has allowed for this environment where the marketplace has outperformed over the last several years because of that, because of hyper confidence that the marketplace has some implicit floor. So to go back into this dynamic, I think there is a lot of contributors you have to peel back and understand the layers of the onion here. But when it comes down to passive and the performance issues, it really is that investors are piling into cheap vehicles. They want exposure to an entire class and not do secular picking of stocks. And they're getting the outcome and the performance that you're seeing.
When you think about the growth of the industry and you keep highlighting this phrase, education, right? We need to inform people. Do you think the industry is doing a good job of educating people either about the existing products or about the new products and how they fit within portfolios?
I think the end consumer has to be willing to be educated and listen. How many times or how frequent does someone read a proxy statement or vote, or also read a prospectus? And so it really comes down to the fundamental willingness of the end investor to understand what they're being led to buy or be invest in, or what someone self-directed wants to pull a trigger on. And so the education is there. Can we do a better job? Absolutely. It really is about, can we find a different way to deliver the information so it's more consumable? And when you talk about the consumption of knowledge, you need, two willing partners, one willing to deliver it, one willing to consume it. So the information is there, in my opinion. And does the industry do a good job? The entire ETF industry was built on education, partnering, and pressing knowledge. So you have 30 years of history here that the community has delivered. I think we've done a really good job talking in singular format as the industry. And if you think of what ETFs have provided, nothing more than access to harder to access products. For example, like gold, soon digital assets called Bitcoin through futures. These are all transformative opportunities to bring more investors to the marketplace. And in order to do that, they have to understand how they work.
Can I jump in here real quick? So this is kind of like my day job. We were thinking about this, and I wrote a book on ETFs about 6 years ago, and it kind of just dawned on me that ETFs need like movie ratings. Mm-hmm. The Vanguard's like G, and then like gold would be like PG, maybe senior loans, junk bonds would be PG-13, leverage would be rated R, and then TVIX would be NC-17, something like that, right? And this is just an acknowledgement that nobody reads the prospectus.
Yeah.
So we made this thing called the traffic light, where we look at all these different things that could be a nasty surprise for you. And it could be taxation, it could be leverage, it could be rolling futures. Rolling futures is a biggie. No normal person understands contango. And then like USO like tracks lag spot by like 20% a year. It's really something that particular area. So everything that rolls futures, you're immediately a red light in our system. I just think that should be on every brokerage platform, in my opinion. I'm not just saying that because I made the system. I honestly think it's probably in the wrong spot on the Bloomberg terminal. I think a lot of people there trying to get it off and just sort of give it away. It's a work in progress. The other thing I think is needed, and what we did, is something called an intensity score. So take like smart beta ETFs, like a value ETF. There's 150 value ETFs. Some literally look like the S&P, and some are like really pure and concentrated and out there. And it's almost like, the alcohol content on a beer. Like, you need to know, is it 6, 7, 8, or 2, or 0? This is very important. And so I think for smart beta, you need a spectrum score. And I think for thematic ETFs, you need it. How much is it into that theme? Because some theme ETFs, like the cloud computing comes to mind, or the VIRS. It's the BioThread ETF. It holds Walmart, Netflix, and Home Depot. And I don't know, you probably buy it thinking you're getting these biotech companies, and it's basically a lot of beta. So I think something that really helps people get to the right part of the shelf in the right aisle would be very needed, and especially now it's needed for ESG. Because there are some ESG ETFs that are, again, almost literally the S&P 500, and then there are some that go a little more hardcore. And we're trying to judge, because the watered down stuff takes hits from the purists. But for advisors who have career risk fears, they actually want the watered down stuff. They fear tracking error, and they will buy it as long as it's cheap.
Well, that brings up a really interesting point in terms of the role of advisors in this process, right? And one of the things that I often wonder about ETFs, et cetera, and obviously this plays into the way that I approach the investment world, but are there additional terms that need to be brought in, right? A very, very clear example, right? Reggie brought up XIV. I happen to know of a extremely sophisticated hedge fund manager who, in the events around February 5th, 2018, was actually buying XIV at the listed price of 75 because he did not know that there was an intrinsic value measure that said it was worth $11 at the time. Right? They thought they were buying it on a dip. They ended up paying roughly $6.
Let me ask you this: if they saw that it was a red light, would they have still bought it?
Highly skeptical, but
But they might have paused at least,
they might,
especially on that day. Well, that day was a crazy outlier day.
Yeah, it was.
But in general, hopefully, like remember the New York Times article about the manager at Target who quit his job because he just bought XIV and it just like gave him money all day. If that were a red light, I'm like, would that guy have bought it, or would he have read the fine print more? I don't know. But
I don't know. I kind of wonder if it wouldn't have been like the band in Boston. You know, a label you seek, right? You know, don't buy this unless you're an adult, right? So I don't know, but it definitely feels to me that there is language out there that needs to be thought of in that context. I know it's something we pay a lot of attention to.
A lot of those exotics were wiped out in March 2020, though.
Yeah.
A lot of the triple leverage ones are now 2x, if that matters a lot. But TVIX is gone. Then again, it is coming back in a different form. But largely speaking, I'd say 70% of the really crazy stuff got wiped out in March 2020 because it couldn't stand the volatility.
No.
Like the triple leveraged natural gas ETN, I think it was going up and down like 70% a day.
Yeah, yeah. Well, the one that I've highlighted is the junior gold miners 3 times ETF.
JNUG.
Traded at JNUG.
Oh yeah, class. It's a legend.
To NAV, right? That was an impressive one. Is the industry doing a good job?
Can I just?
Yeah.
So, in defense of the exotics, and we call this whole and I'm not going to put ARK in the same category as XIV or JNUG, but it's sort of like, we'll call all this hot sauce. It's the term I used, but used it earlier, I think. I do find that there's this interesting barbelling going on where portfolios have gotten so boring in the core. You know, you buy Vanguard 500, 3 basis points, and you're like, that's 80%. You buy BND or whatever, and you got your whole exposure for 6 bips. But it's so boring, it's like watching paint dry. So what people are hungry for is something really crazy to have fun with 10 or 20%. And that's where those products, in a weird way, might serve an actual good purpose by making you not touch the 80.
Yeah.
And just to occupy yourself a little bit. So we do find that when you look at the 13Fs of, say, a JNUG, only like 5% can be found in 13Fs, meaning it's retail. So we do think that on one hand, these are probably dangerous products for retail, but on the other, if you talk to people anecdotally and you look at the flows, it does appear as though most of their money is going to the vanilla, but then instead of going for like a T. Rowe Price blend fund to put on top of your vanilla, because that's the same stocks anyway, you go for an ARK or you go for a JNUG or something.
Yeah, no, so that actually is exactly what I was going to hit on is, do you think the industry has done a good job of designing products for the younger generation? Because this is one of the hard parts about asset management, right? Is you highlight it in terms of go where the money is, right? If you're going to rob a bank, that's where the money is, right? I forget who the guy is, but all of the products are like watching paint dry for the most part, right? The younger generation seems to have been drawn to products like crypto, et cetera, that have a much higher level of volatility. Have we missed something?
This is just, I think, a bull market also. Yeah. It's easy to make money. We sometimes ask ourselves this hypothetical: if the Fed hadn't backstopped the bond market in March 2020, would Robinhood even be around? I mean, I just don't know if you'd have the courage to do what's going on over there if the S&P has this long, like say 50% drawdown over 2 years, which it would have. I think bond mutual funds would have had to halt redemptions if the Fed didn't step in. It would have gotten really bad. Probably would have started going up right about now, but it would have been so bad, I think it would have scared a lot of people off. So this is a little bit of like bull market confidence. On the flip side, I think it's also the rise of Vanguard. I always say the reason Cathie Wood's so famous is because of Jack Bogle. Jack Bogle completely took the land from T. Rowe Price, Fidelity, American Century. He stole it, and that's the core of the portfolio. So again, now people want active. They want Cathie Wood style active, not the closet indexing type active. And so the middle is now a no man's land. So I don't know. I don't know if that portfolio is better than the old one in the 90s where you had T. Rowe blend in your middle and you paid 80 basis points to probably underperform. Or is this way better where you have boring Vanguard, but then you could risk losing all all of your 10% fund money in a heartbeat. I don't know.
What's your thought, Reggie?
Well, I think the products that are designed are for the young people. If you look at cannabis and all the thematic ETFs, they were designed unfortunately, for people chasing returns, but people understanding, or investors understanding, they wanted to have exposure to certain asset classes, and ETFs have made it easy for them. So, I think I haven't seen any recent research on this, but I think the underbelly of the ETF industry is the younger investor, or an investor that wants to be self-directed without advice. So I think the industry has done a fantastic job in that area. I think the underlying question you're asking, are the products that are being designed suitable for these investors? And is there a class of products that are not suitable given the complexity or the structure for long-term investing? That's another topic altogether. But if you look at my two twins, they're 21, and they're big ETF users, not because I advocate it, because in college, they were all talking about it and buying on retail platforms that gave market access for very little or zero, and allowed them to go buy thematic ideas based on what they're exposed to at the time. So this is the fundamental structure the ETF industry has allowed.
Well, I think that's actually a great place to start to wrap up, since we're running out of time. But I think what is broadly being highlighted is the idea that this continues to be an area of innovation, that it continues to be an area of growth, and the industry has a unique opportunity and responsibility both to educate about the new products that are coming out and to continue to give people, kind of the plain vanilla stuff within the more efficient wrappers. We've come a long way, is I guess the way I would phrase that. Gentlemen, thank you so much for joining me on stage. Reggie, I'd love to meet you in person at some point once the world settles down. Eric, it was fantastic seeing you. Hopefully I'll see you in Philadelphia soon.
Yeah, anytime.
Excellent. Thank you very much.
Thank you very much.